Hi, I'm Gary from Revenue Real Estate Education and Rental House Profits. Make sure you click subscribe below and click the little bell to get notified of all our latest updates and top tips. Hi, so this week with Revenue, we are going to look at 6 ways to make money as a real estate investor. So number 1, this is make money when you buy, or sometimes it's called forced appreciation. So what you want to do is either look for a motivated seller, so somebody that's got a reason why they may be willing to sell it for a little bit of a discount. They may be moving out of province, they may be moving for a job. There's the other terms, we've picked up houses because somebody's died and the family just wants rid of the house. Divorce is another one. There's reasons people become motivated. Now, I'm not saying look for all the misery in everyone's life. Some people are happy for you to take on the house. It might be a problem house that they don't want to deal with. It might have repairs that they don't want to spend any more money on the house, or have the money to spend it and they're happy to walk away from it, especially if it's a retiring couple and they're downsizing. Why do they want to spend any more money on their big house that used to be their family home? So say if you can get it at a bit of a discount. I mean, you hear a lot of people saying you can get it at 40, 50 cents on the dollar. I don't look for that. I look at for market value, and if there's a small discount, great. If there's not, there's also forced appreciation. So you can buy a house for what it's worth as it stands, and then you can do, for every $1,000 you spend on the property, can you get maybe $1,200 back in value? So if you put a kitchen in and don't overspend, are you going to get that money back when you spend that on renovations? So that's forced appreciation. So that's one way of making money on real estate. That's our first step when we buy a house. Can we increase the value of that property? And the money we're going to spend to increase the value has to be less than what the value is going to be increased by. So we're going to create a margin. That's one way of creating money in real estate. Number 2 is cash flow. So if I buy this house and I'm going to rent this house out, after all the bills are paid, is it going to have a positive cash flow at the end of it? Is there going to be money left over that we can put into a fund, that we can build up in a fund and then take that out eventually as income? So number 2 is cash flow. Now, we always look for houses that cash flow. Not every market is going to cash flow, or it may not cash flow in the way that you think. So you got to get creative when you start looking at cash flow and start thinking of other ways. Does it have a garage on the property that you could rent the garage out separately? Or if you want to be English, the garage. Number 3 is the principal pay down. So if you've got a fixed term mortgage or a variable mortgage and you have a mortgage with a bank or any lender for that matter, over time, you're going to pay down increments towards the principal of that property. So principal pay down, and that's something you can calculate over time because you're going to make those mortgage payments. So you know with a degree of certainty that that is what it's going to get paid down over time. Number 4 is appreciation. Now, we've talked about forced appreciation, but what we're talking about is market appreciation. So what we've seen recently in all over Canada actually, and we've seen house prices increasing over time. I mean, we've seen crazy increases, 30, 40% increases year over year for the last few years. This is in 2018, as great as it is as an investor, this isn't the normal. So don't come into a market thinking that every year you're going to get 20, 30% appreciation in your property. Okay, so that's another way that you can create money as a real estate investor. The other one is leverage. So when we talk about leverage, this is you're not using your own money. You may come into a property and buy a property for $300,000. You're going to put about $60,000 of your own money into that if you're doing 20% down. Now, if the house price goes up, as we discussed in one of our other videos, calculating return on investment, if the house price only goes up by 10%, that's $30,000 on the 300 grand purchase price that it's went up. But because you put 60,000 down, you're getting a $30,000 return. That actually works out at a 50% ROI, return on your investment. So appreciation, that's leverage, using appreciation with leverage, using someone else's money and you're getting paid on the benefits of that. Now they're making money on the interest, so they're happy with what they're getting, but you can also, if you're clever, you can leverage. Now don't over leverage yourself, but you can use leverage to help you get higher returns. The other one, and again, this is something you want to speak about with your accountant about, but there are tax benefits to owning rental properties and real estate. The reason being is this is a business. This provides houses for people, it also provides jobs, and it also provides income. And all of those things, the government, especially the jobs and the income, the government can tax you on that. So there are various benefits that you get, tax benefits for owning revenue real estate. So again, speak to an accountant about that, but there's the 6 ways. Make money when you buy, forced appreciation by renovations that you do, cash flow, principal pay down on the mortgage, appreciation of the market, leverage, using someone else's money, whether it's the banks or a private lender, and then the taxable benefits. That's the 6 ways that you can make money as a real estate investor. If you'd like to comment or any other ways that you can think of, please leave it in the comments below. If you haven't already, subscribe to our channel, and we look forward to seeing you next time.